Hi everyone. Pleasure to be in front of this audience and back to the alma mater. It's always good to interact with fellow alumni and students. As the topic Professor Ganesh highlighted, we're talking about fintech, and within fintech, digital lending, which is something which just to in terms of couple of seconds on this particular topic, how we arrived at this. Fintech is a vast, spectrum of activities. Essentially, whatever is financial services, traditionally known as financial services, you overlay some tech on it, either to acquire a new set of customers which were underserved, or to essentially come up with products which were not there, or do the business in a way which makes lives easier for masses. So anything which overlays tech can be called fintech, along on the traditional base FS backbone. Within that, within fintech, one would try to highlight the key spectrums, including payments as one of the large ones, which you all would have heard of: Paytm, Bharat Pay, Google Pay, Razorpay, etc. Then obviously there is other verticals like wealth tech, insurance tech, etc. Our focus today for this panel discussion is lending, using technology, so digital lending in this era. And we have kind of consciously the panel here sort of represents a comprehensive view across operational expertise, investing, portfolio management, fundraising, and lending, which is all a part of any digital lender. Just a quick fact, in the last 5 years, more than $9 billion have been raised by fintech digital lenders in India.
I think where Pratik was talking about was the size of the entire fintech industry over the past 5 years. The kind of funds that have been raised and invested in this sector has been great. Over a period of the entire hour, what we want to do is talk specifically about digital lending, also discuss the basic classifications of how can lending be done. I think, Kamal, you want to add what the other sections of what we're going to cover?
Yeah, so basically, like to touch upon a bit of how lending has been further substituted and enabled by fintechs, and they're coming into the picture. How, yeah, Pratik is also back, I guess, now. Just to also understand how more flexible products and more variety of products has been created because of the involvement of fintechs getting together with the overall standard lending structure that exists. And so that was the area overall. And then gradually we'll also try and touch upon how the regulators have played a role and what fintech can do beyond just substituting the lending aspect, but also try and create more and more inclusion in this space. So that is what we would want to cover over the next, say, half an hour or so. So Pratik, we lost you in between, so we've just taken over. We're just glimpsing on the basic ideas. So over to you.
So this is the first point, and then handing over to the panelists for to like to look at lending, digital lending as a landscape. The one easiest way is business lending versus consumer lending. What's your view on, which one is a bigger market, which are the nuances of business lending versus lending? There have been more success cases versus which are the more tricky areas. So, maybe one of you can get started and
this. So if you're looking at the different types of lending, you could look at classifying the market based on collateral, whether it's secured or unsecured lending. You could also look at how the lending is being delivered, as in if it's an embedded solution, or is it worked into payments, or is it linked to revenues, or maybe crafted as a working capital solution for business to use. So one aspect of lending is how it is being deployed or delivered, right? Another way you could look at is the tenure of the entire loan and what kind of yield the loans get. And this could be like a short-term loan, it could be a payday loan, it could be a loan which is over a period of 50 years, right? And another way of looking at lending is via different business models. For example, you could take a look at a pure play NBFC, which is effectively just doing lending per se, right? Or you could look at a marketplace for all loans like Paisa Bazaar or like Bayana, right? Or you could look at commercial lending where there is business software and lending being provided as a package. Someone who does that is Rupeefy or Off Business or GetVantage, right? You could also look at vertical focus plays or industry focus plays. For example, Homeville does lending purely focused on housing, right? Or you could look at app-based lending. There are so many apps. In fact, app-based lending recently had come into the news as well. Okay, you could look at the different kinds of products that are there. You could there's the classic home loan, mortgages, loan against properties, education loan, loan against receivables, right? Or you could look at the B2B side of things. Over to you, Kamal.
Yeah, so if you look at specifically lending, at Caspian also what I've been doing in the recent past and what we've been looking at is clearly demarcating lending for the purpose of income generation versus that of personal consumption. So both these markets have grown significantly large today, and the lending for personal consumption is something that is improving and gaining more momentum with the help of a lot of technology interventions. At the same time, the bigger segment, and which actually does a larger impact on the ground in terms of the contribution to GDP growth and overall, you can say the macroeconomic factors that it brings to the table, is lending for business growth, especially when you are connecting the underserved or the limited segment, which is the MSMEs of today, which are basically are not able to either access capital or not able to access capital at the right rates to fund their capital and business growth. So that segment certainly is gaining significantly, and that is one of the larger segments of the overall picture, wherein B2B lending has become much more common. MSMEs have been able to access capital from various technology-enabled NBFCs and banks, also getting access through these intermediary technology partners through which they're able to reach out to the segment which was untapped, maybe because of the reason of the ticket size earlier, because it's a smaller ticket loan. It's not something that you can easily have that kind of a manpower to back it up with. And especially if you look at it from the perspective of collections, the last mile linkage also becomes much more better with the help of technology. So that is where a lot of improvement has happened in the B2B space. If you look at especially, so what has also happened is that within the MSMEs, a lot of newer product innovations have also happened. So a simple working capital loan is now further broken down. The latest product being the revenue-based financing segment, which has enabled even loss-making entities and growth-intended entities to come under the lens of lending, which wasn't really the typical scope of any banks in the past. So back just after graduating, when I joined a bank as a lender, we were very clear that you need to have 3 years of audited financial statements showing profitability to even become part of the lending segment, which today is not necessarily true. So that paradigm has completely shifted from being a large audited entity having significant revenues and profits to get access to even any kind of borrowing capital versus the MSMEs of today, most of them having unorganized segment incomes. So that has also, has opened up. So
Uh, Relevant point here, Kamal. Thanks, Prasad, for earlier giving those categories. Business, consumer, or secured, unsecured, within credit, sort of commerce plus lending or plain vanilla lending, right? Or for that, for example, payments plus lending like Paytm or Razorpay are getting it. Or in terms of examples, commerce plus lending is say a Rupify or a Oxizo along with of business. Now, Kamal touched upon is banks not uh, serving those sort of customers. Somewhere Kamal touched upon a certain methodology of writing, which banks use or are still following for certain. Vis-a-vis what the fintechs are doing, um, enables them to tap into the so far underserved market, which the SMEs, for example, which do not have credit access. Or take the example of Slice or such other companies have been issuing credit cards to teenagers, right? Or FamPay for that matter. Um, is more importantly, I think that banks are now in the same zone as they were years back, or do you think there is change? Do you think the incumbents are also realizing the potential for growth in areas where fintechs are focusing? Definitely, banks had the advantage to start with. There, anybody could.
I'll take this. So banks typically look at fintech for one definitive use case is to absorb their capabilities. So, for example, most banks usually have the kind of services that uh, consumers dream of, right? However, those capabilities are not easily exposed, and that's where really a fintech creates these capabilities and essentially distributes these capabilities over a much larger network, right? Let's take the example of payments. Banks do have the capability of setting up a NACH and an eNACH, right? However, there still are payment gateway providers like Razorpay, right, like Cash Free. Banks have the capability for creating an escrow account and managing the entire transactions on top of that. However, then there are fintech solutions which give a wrapper on top of that and make the entire management easy, right? There are cash management and transaction management solutions that banks also have. However, fintech apps that build a layer on top and expose that and help essentially distribute that really make a difference for the bank, right? Therefore, a lot of banks look at fintech providers as the easy way to acquire a capability and distribute it as well, right? I think another different look at how a bank might think about a fintech, and this is as a fintech, so I'm of course biased, that finally at the end of the day, the funds have to flow through a bank account, right? So if whatever I do at the end of the day, even if the fintech becomes a unicorn, right? At the end of the day, that fund has to lie in a bank account, and therefore the bank says, "Oh, you know what? I should probably collaborate with you so that you grow and help distribute my CASA," right? So I think largely banks are looking at fintech not just as a competition anymore, but rather a collaboration point, as a ability to scale and suddenly acquire a whole new different set of capabilities, which otherwise would have been very difficult for them to acquire, right? I think another thing that most banks are looking at in the country right now is, the ability to quickly catch up with the other more modernized banks or the more modern players. And that's where also fintech plays a good role, right? A lot of the experiments that a bank may not be happy to do within its own regulatory frameworks, right, can still be possible if fintech were to partner with them, and then there was a very, very controlled environment to create that. The fintech can also go out all out and then apply for a regulatory sandbox access and then create something which a bank would have taken a lot more time,
Mm.
right?
Got it. So in essence, what you're saying is banks are looking at fintechs as enablers, as more for collaboration, and not as competitors necessarily. Probably has to do with the scale at which banks are, and the structures which they follow. So it makes it easier for them to uh, collaborate and join hands with the fintech and move fast into a hitherto untapped market. Um, any views here, Kamal, from your banking experience, or Amish from your portfolio management experience?
Kamal, you want to go in first?
Please go ahead, Amish.
So good, Pratik, thanks. What we are seeing is a lot of collaboration happening, especially on the business side, because these fintechs are able to get a seamless flow of information, ability of assessing things in a better way. I'll take an example. There's a company called Vyana, which I think Ajinkya referred to in his earlier discourse. Now, this company is like what he claims. He says that I am like the MasterCard or Visa of the B2B supply chain financing. So what he does is he's the largest GST solution provider. He assesses a lot of information about a company, and what he gets to know is a cash flow mainly. He's not assessing the balance sheet strength. He's just looking at the cash flows and then working with a corporate and a bank to stitch a program for the vendor, the guys who are the customers of the corporate. Let's say if Jio has to sell this 1,000 rupee handset to across 3,000 retail outlets, which retailers are there. So how do I enable a program so that their bills are discounted, which are raised, which I raise in their name, and I get the money immediately. I don't have receivables. So a bank would not be able to ideally go to a retail dukandar, who's selling that, handset on the ground. So here is where a guy like Vyana comes in, prepares a whole program, and today runs it effectively with banks. So banks are doing the lending. He's just a pipe enabler in between, making a small cut in the journey, but still being relevant for the ecosystem. So that is what I would cite as an example of how some of the fintechs are relevant to banks today. Yeah, thanks.
Very relevant example, and to add to this, even co-lending, Amish, that's something which we've seen actively. I'm aware of, Homeville having co-lending partnerships. Maybe Prasad wants to quickly chip in here before we hand over the, mic to.
I mean, another quick way to have a blended product and to merge, richness and capital is where I see co-lending evolve and eventually make some interesting structured products out there, right? And this is where if there is one company which has distribution and one which has access of capital, right, they can come together and suddenly create a distribution of capital via its network. And I think that's where I see co-lending evolve eventually, so that most partnerships will eventually end up being one form of co-lending play or the other.
And using it happening across public sector and private sector banks, or is it only a few names which are more active in co-lending?
I think it is across both public and private sectors. In fact, there is definitely one experiment or the other with most of the large private lenders as well, where they are trying their hands with co-lending.
Over to Kamal for any additional views.
Yeah, so I mean, certainly agree with all the points being discussed here. What I would like to just add is that banks have also understood that this is not one person's problem to solve, and financial inclusion in itself is such a big issue that to bring everybody under the umbrella of just basic financial transactions itself is a core and large activity which requires multifold styles and actions to come together to actually create a solution for the kind of large population base that we're trying to cater to over here. So everybody is aligned in that. The other part is wherein the regulator has been trying to play a very important role is around the fact that financial inclusion also leads to a lot of financial frauds. And somewhere or the other, I mean, the idea is to de-risk the customer from the aspect of those frauds that are going to come. And that is why a lot of regulations are initially not so much in favor of how a fintech player is trying to disrupt. Because disruptions, although good, but can also target some of the loopholes of the existing systems. And that is where some of the fraudsters can actually make a lot of benefit, quickly come in and move out. And that is what happened in the apps that Ajinkya also mentioned in the loan apps scenario. And similarly, when it was peer-to-peer lending guidelines which had come in, there was a company that we were investing in back then. Before the guidelines, they were a totally different segment that they were trying to cater to in a style. But once the guidelines came in, that business itself rendered itself a kind of a useless model, and then they had to shift themselves into an NBFC structure altogether. So, but on the other hand, coming under the regulatory purview becomes important given the fact that the loopholes should not be taken benefit by some of the fraudulent players in between. So that's what becomes very, very important to note is that yes, fintech growth is certainly faster than what a regulator and a typical bank can even think of. And it gets slowed down because of these interventions, but at the same time, it is necessary because even one person's money getting lost because of this entire revolution coming through is a loss to the country.
Thanks. That makes sense. Just conscious of the fact that we are at half time and trying to now switch gears. We covered, the fintech sort of a lending business models and customer segments. We've also covered, how it's a problem which banks and fintechs are trying to solve together, right? Whether by coming up with more flexible products, smarter products, or more operationally efficient ways of handling some of the low size and stuff like that, or just combining commerce along with lending and providing that experience to the customer. Moving on to something which is more topical, and it has always been important, but recently has gained more sort of focus, which is to do with the profitability, basically scaling up in a profitable manner, right? So and it's common across startups, applies to fintech and digital lending as well. Something around how would we like to make sure that while there is a passion which a fintech is trying to solve for, let's say they want to solve for the lack of credit access to MSMEs, or the inadequate credit access to, make sure that while following that passion and trying to achieve that goal in collaboration with banks, the business makes money. The shareholders also make, create wealth. That's the other thing where I would like some of the panelists. I can maybe touch upon some of the key metrics, which needs to check for to see whether the direction is right or not for a fintech business model. Would Prasad, would you like to start, and then we can.
I can talk about the operational aspects of these metrics, right? So if you look at lending, I see lending based on three large pillars. One is how you are sourcing your cases, right? The way, what strategy you are using for your distribution. Another pillar is how you are underwriting these cases, right? Is it rule driven? Is there makers taker? Are there any escalation matrices? What are the rules and what are the caveats that cover those rules, right? And lastly, no lending discussion can be complete without collections, and therefore how much efforts you are putting into your collections, what collection strategies are you employing, right? Any kind of operation metric in these three aspects, right, will be useful to track what kind of sourcing numbers do you have, CPA, CPL, right? What kind of underwriting you're doing, how many times did you see a deviation, and deviation management metrics, right? And the third is how effective your collections are there. If you are seeing delays or DPDs, right? What are your buckets looking like? What is the classification of those, right? Uh, how many of those were taken at what point in time? I mean, there are so many metrics that you could cook up with in these three pillars itself, right? That should typically be something that that tells you about the how the operations of the lending businesses. However, from the finance side, I think you are the most suited to cover those.
Thanks, Prasad. Helpful. I'll try and add a little bit on the. So essentially, what you mentioned, right? The sourcing strategy. What that translate on the finance side is the cost of acquiring a customer, right? The CAC as we know it. So on the cost side, in fact, I'll quickly sort of present one small one pager, which is more like a ROA tree, which we typically refer to when we are, let's say, trying to understand the business model of a lender, of a digital lender or a normal lender, right? It's probably the same. So gross yield, right? This is your top line. This is your gross revenue, which is essentially your rate of interest, your processing fee, right? Any other extra charges which you're charging the customer. Then you obviously arrive at the net yield by reducing the cost of funds. Now, it is a function of your borrowing sources. If you're borrowing, if you're well rated, if you're well capitalized and well rated, you are able to borrow from banks. If you're not very well rated, if you're in the triple B or thereabouts, you would borrow from probably larger NBFCs or other NBFCs, and the cost of funds would vary. Cost of debt would vary accordingly. And then obviously the leverage at which you operate, which ultimately gives you a net yield. And then it's a function of the operational efficiency. The higher the AUM, the better it is, because most of these costs do not increase in the same proportion as the increase in the disbursement or AUM. Your employee costs do not always proportionately increase that proportion, right? So you get the benefit of a higher net return. If your AUM is scaling up, your cost mostly is sort of semi-fixed in nature, and that's where the operational leverage kicks in. So this part is the financial leverage, your how geared you are, and this part is the operational leverage, your cost remaining same, and your yield increasing because of the AUM growth. So that's the way we, at least I, in my experience, have been at some of the situations. Maybe interesting to see how a lender looks at it, right? Because fintechs, let's say, Kamal, when you assess a fintech lender who may or may not be making a profit, right? How do you, from your perspective, look at assess, whom to lend money to and how much?
Yeah, so that's interesting because most of the entity that we typically enter is at the stage when they're not really making profits. So what we try and assess is whether the unit level economics are actually making sense for them. And after a certain level of, say, scale, they would be able to, idea is to understand whether after a certain scale, will they be able to achieve that kind of profitability which they're vying for. And that also stems from the fact that we try and not just look at the fact that it's because in general, I mean, a lending business is a profitable business. If you look at the overall, there have not been, unless and until there have been siphonages in from the real core business activity to some other aspect. A typical lending business has always been a traditionally profitable business. So that's not a worry for us that after a certain scale, this company will certainly make profits. What we need to know is that those abilities to siphon off funds or say to try and do other aspects are taken care of. So basically, we try and look at more from it from a governance standpoint. How well is the company sticking to its operations? How well are they focused? How clearly are their operational guidelines mentioned? And to what level are they being followed at each stage? So from right from the promoters to the key management to the next line of management to the on-ground staff. At each level, what is the understanding of the policy and the processes? That becomes more important for us rather than looking at just the key numbers over here. And other than that, from a number perspective, we also do look at that what is the scale of operations currently they are at. So certainly after a certain scale, it does make sense that they would be able to generate those kind of positive cash flows, which will impact or create a positive PAT for them.
So in a way, you are also trying to assess whether that particular fintech will reach a certain scale in a certain time frame and has enough capital buffer to reach and absorb losses while it reaches.
Yeah, so from that perspective, certainly the cash runway becomes very important, and for which we need to understand how the equity investors. So as a lender to such startups, we always rely upon the comfort that is drawn from the equity investors already playing or working with that entity. And how typically lending to a startup a fintech entity helps is that if effectively it's non-dilutive capital for the promoter to continue on the growth path and elongate the runway to that particular point when they become profitable in the long run.
Yeah, no, makes sense. And that the non-dilutive word reminds me of our investor friend sitting here on the panel. So Amish,
Yeah.
Profitability obviously is a very topical word right now in this ecosystem, and your views on the entire landscape in terms of investor activity or appetite, um, uh, obviously in general, but more towards the fintech space. We saw a couple of years of very, very high intense activities, and then obviously last few months are completely different. Maybe you could share your view.
Sure. No, thanks, Pratik, and thanks, Kamal, for getting that segue here. Maybe what I'll try to do is, go a little top down. Okay. Maybe it'll help in some of, to the students here on the group. It'll help in your conversations with the larger world also. That what is happening, this whole fintech winter, and there are some questions also on the group, dry powder and, recession and, all those words. So let me just cover it very broadly. What has happened in the last couple of years and where are we today? There have been some very good tailwinds with the country so far. I mean, and they still exist to an extent, but the whole, consumption trend in the country, the core is, population driven consumption, which is leading to more production, more manufacturing, more sales, more debt, more lending, etc. That's the whole core genesis. To add to that, what came in is the whole, government support, the jam, as they call it, the Jandan, Aadhaar, and mobile, these three revolutions, right, which have added a lot to the digital format of consumption and digital format of lending and fintech overall. Okay, so I'm just building a segue of where we are getting into. Jam, because all these bank accounts are there, the geo exploration and, Aadhaar link stuff and, to the Aadhaar. So that Jam is the positive part. Coming to that, third part is across the globe. The growth engine has been India and China for the world. Maybe 10 years down the line, 20 years down the line, it'll be Africa. But right now it is these two economies. And what has happened over the last 2 years is COVID accelerated a lot of digital adoption, and China was a little strict on their government policies and things like that. So the whole focus came down to India. Okay, that this is the market of growth, and everybody knows that this is a market which is very conservative. Our savings ratios, etc., have been the highest. The loan ratios have been the lowest. At a personal level. Now at a business level, now that there is a lot of growth, how do you fuel growth? One is raw materials, etc. The other thing is cash and money. That's where a lot of scope came in for SMB financing or things like that. Because if you are able to fuel growth and fund a guy, he'll be able to grow. Typically, if you see, in our own respective families, if our parents are into small and medium businesses, the constraint is management bandwidth and money. Okay. But many of the times, if money is coming in, then they'll be able to grow way faster. So that's a whole segue building to why India has been seeing a lot of innovation, because banks have always looked at cash flows and balance sheets, and in India we know how tax planning happens, right? So because of tax planning, balance sheets are not strong and banks are not able to lend. That's where then SMB like a Pratik and Ajinkya will be smart. Hey boss, the guy has paid only 10,000 rupee tax, but he's gone to US this year. He lives in some posh area in a 4-bedroom and has a Merc. So they will see that and then figure out that there is cash happening, so let me give a loan to him somewhere. Of course, it'll be high cost because had he gone to the bank, he would have got a 10%, but he's not able to go, so he has to come to us and borrow at higher cost of borrowing. So that is what has happened so far, and there is tremendous scope for further improvement. And that's why a lot of funding came in across all domains of fintech, be it payments, be it lending, be it wealth, insurance, etc., etc. Now, what has happened over the last 1 year? All this whole winter story. Unfortunately, the interest rates started going up in the Western markets, and they said that because interest rates are going up, things which was easy money, free money available will not be available. Okay, so there started coming in the pressure of what to do. And in one of the forums, when I was sitting with and speaking at a forum where the RBI equivalent of Switzerland was sitting, okay, they said that, hey, for us, it's okay to take pain. We are increasing interest rates proactively after a certain long period of time. There will be some pain in the economy, but it's okay because unnatural high level of inflation cannot be sustained eventually. So inflation is a genesis for interest rate increase. Okay, that's the whole core. And their RBI equivalent head is saying, "Ke chalega, thoda pain hone do. Some people will suffer, some companies will die, some people will go bankrupt. It's okay for the larger good of the economy." So that's the whole genesis which is leading to this, interest rate going up. And accordingly, when you look at US or these very evolved markets of developed world, there any improvement in matrix leads to money getting flowed to other channels. So what is coming to equity is not going to debt. Second, there is a concept called hedge funds, like Tiger. You would have all read about Tiger Global and things like that, which were like the hot investors in India a year back or so. Now their money is fungible. They can put in public or private, and their private markets are going down, okay, because of whole this sentiment. So they are saying we can buy things cheaper, because if we want to generate, let's say 15, 18, 20% return in India, there is a risk. We are still not a developed economy. But if they're able to generate that kind of return in their own market, they will be happily putting money there, because stocks are going down. A multiple or in let's say if the multiple in a SaaS market was 30 times revenue, it is now 10 times or 7 times. So things are cheaper, fundamentally good. So why not invest there and make more money 2-3 years down the line? So that has led to the overall sentiment ke market is down. It's all eating into each other, and money flow is getting little lesser. Okay. Now coming to the dry powder side, actually there is no less dry powder. India has a lot of money. Sequoia has raised $2 billion for India. Axel has raised $750 million for India. Elevation has raised $650 million in India. So there is a lot of money sitting. But what happens is these are all professionals. Okay. When a proposal comes, let's say Pratik is working in a fintech and let's say Chiratae has to fund it. So he'll come to us, okay, and we'll discuss, we'll evaluate whether what's the pro and con and stuff. We will see, now how do we also take a bet? Is he becoming profitable? Will he be able to survive if we fund him now? But if he doesn't get the next round, what will happen? If he dies, then our funding also goes for a zero. So the ability to take risk has gone slightly lower. That's why professionals are not taking bold calls. But whereas if a company is able to demonstrate profitability, okay, in this market, and that's a segue to reason why profitability is becoming important. Because if he's profitable, if we fund him now, okay, for growth, he will not die. The mortality risk will go away. So he will survive. So let us fund a guy who's profitable in its core, inherently, and hamare paise se he'll be able to grow. And in this market, what will happen is some people who are to die tomorrow will die today. So the market will consolidate and our position will further improve. So one of our portfolio companies called Early Salary, which is into consumer lending, went to raise $50 million in this market. They were able to raise 100 million because they were profitable for 12 months in the past. And then high quality investors said, we have to take a bet. Okay. So they looked at the segment consumer lending and then they said, hey, this is the best set of people because they know how to manage their show. Okay. So let us fund them. And that's how this company was able to raise double what they went to market to raise for. Of course, valuation was slightly lower. Matlab, in the last round, if he got 100 rupees as value, he would have expected 300, but he got 200, which is okay. He also said, I don't want to go for a frothy valuation, very high valuation. Let senses prevail. Let me take the money and survive for the future. And this is the time where I can do better than others. Okay. So I hope, Pratik, I've tried to cover the story from there to now. So, in your group discussions, interviews, I think students can handle some of it. Yeah. Thanks.
Very, very insightful, Amish. And you actually while covering this comprehensively, you kicked off and answered some of the questions also. So thanks for that also, because I see a couple of questions in the chat box around low dry powder. I'm sure 2-3 questions would have got addressed this. And maybe now, it's 10 minutes to 5, so maybe we should switch over to Q&A, probably take it from the list which was sent to us a few minutes back, few minutes prior to the session by the students, and then a couple of others in the chat box. I read out quickly, and then one of you can take it. So the first one is around Mumbai Fintech Hub. It's one of the first in Maharashtra and has been the first state to implement fintech policy. How important are these initiatives for the sector, fintech sector, and do they really make it easy for the startups?
I think I'll take this. I think something like the Mumbai Fintech Hub, and there are multiple flavors of this, but essentially they help a lot in twofold. One, giving a voice to the fintech, to the larger powers at play. A, the regulator. B, banks. C, the policymakers. Right. And B, it also creates a good networking hub for people to exchange ideas, to see if their products can work with each other, if additional products can be co-created, right? So a lot of fintechs typically work with each other, even if they might be competing in one market, but they will still be, supporting each other in another. So I think a hub like this definitely helps develop the industry. At the same time, create some sort of a protected environment where the regulator can also oversee, at the same time can also enable.
Thanks. Thanks, Prasad. Quickly moving to the next one. This is about the overall deal volumes, in terms of VC investments and M&A and PE. Seems to have fallen down, was around 11 billion in 2021 and fallen down to 9.5 in 2022. Just, around, I think Amish did cover probably this question around what's the current environment and how do, investments. Probably if Amish or someone in the panel you want to talk about how long do you see this relatively low, sort of less players getting funded sort of an environment to last, and when do you see the tide turning?
So Fun, nobody can do crystal ball gazing here. It's all linked to this, interest rate regime, and we keep hearing things like that. The moment they stop raising interest rates, possibly things may get better. Now, is it 1 quarter, 2 quarter? We don't know. Okay, but fundamentally, one good and one bad part about ecosystem right now. See, a lot of people are growing at the cost of nothing. Like Kishore, let's just grow. We've got the money. Let's just grow at any cost and means. And when you set up a business, what happens is, does the entrepreneur have every skill? One is acquiring a customer. Second is, managing the balance sheet. Third is managing cash flows. Fourth is managing people, getting the right team. Fifth is having a good technology. So it's a lot of many ingredients. And many people in that frenzy, everybody was getting funding. Now what is happening? Those who have quality and class are getting. Unfortunately, they just come little early. The guy would have wanted 1 or 2 years of more peace. कि चलो मुझे सीखने तो दो, मुझे और करने तो दो. But now, suddenly exam has come. I mean, we have not prepared, an exam has come. That is what has happened in the market. Okay. So that is where the situation is. And those who are fundamentally strong will survive the, test which has come, and those who are not will fail. So to that extent, that's a general answer. Nobody, I mean, of course, all of us are praying that this winter go, because we have invested in a lot of companies. We are an early stage guy. We want late stage guys to come in our companies, right? So we are all praying ki jaldi ja winter. But yeah, the whole positive optimism is, after winter there is spring. So we are all waiting. But the good part is, good companies are getting funding. I took examples, okay, couple of them. So there is money available, there is money coming in. And even if you read now in papers, fintech segment is getting funding, though there is a lot of consolidation, because people are now realizing, can we come together and work? Like, Prasad's business has customers and Pratik's business has a good technology and wherewithal. Can we come together? So both of us solve the problem, because Prasad is good at getting customers, but Pratik is better at getting and managing the customer. I'm just throwing a notional example. So this is where consolidation is coming in. Okay. It could be led to stress or it could be led to logic, both. Yeah. Sorry, Pratik, back. Yeah.
Oh, yeah. Thanks. That's helpful. So quickly on, financial inclusion, probably this Kamal is well placed to answer in terms of how the fintech industry can impact financial inclusion and complement, the traditional financial institutions.
Yeah, certainly it's going to complement, it's going to help and aid the financial inclusion and the pace of financial inclusion in the country. I mean, the entire microfinance revolution has happened on the back of strong operations in the past, but currently, if you look at it, the model of the JLG, the joint lending groups and things like that, is somewhere shifting to an individualistic borrowing. And when it comes to an individual loans and individual borrowing methodology, it's the numbers and the technology that can fathom more information. So just from a credit understanding perspective, what fintechs can actually aid this growth from a JLG mode to an individual loan mode in the entire, you can say, sub 1 lakh kind of loan ticket sizes is going to be significant. And the play that technology is going to bring in is certainly is going to fast track the entire speed of acceptance for financial inclusion as well. So no doubt, the only thing is that, I mean, at the end of it, the fintech implementer has to be very clear in their ask and tasks that they have to focus on inclusion and not just focus on, the transaction itself, but focus more on the overall broader perspective of bringing everybody under the umbrella of financial institutions.
Well said, Kamal. In the next one, automation is there in, rising fastly in the finance industry across, asset management, trading. How will fintech impact the job market? How will automation impact the job market overall? I think coming from some of the students, of course, and probably within the job market, the fintech landscape. Maybe I'll direct this question to the techie in our group, Prasad. You are partly to blame. So why don't you explain? Have a stab at this one.
As a tech guy, I would always say that automation is going to make everybody's life awesome, right? Having said that, let me also explain. Automation typically takes away the drudgery of work, right? if there is a step-by-step process that has to be followed over and over again, right? That's where automation can come in and take away that part of the work, right? That pretty much means that the average employee can look at other aspects than the treasury, right? Take away treasury from work and you have a pretty interesting work, right? You can engage so much better at work. All right. So I think any kind of automation where legacy systems, for instance, have to be worked with, right? You can suddenly put an RPA on top, and that entire legacy system can therefore be accessed and integrated with modern systems, right? For I'll give you an example where we use this in our day-to-day job. What we have done is in one of our products, we have to push a case to a bank, right? The bank doesn't have an API; they have a legacy system. So what we have done is we have built a layer on top, which is an RPA, and our platform directly removes the RPA, and nobody has to actually does the task of filling up the form, right? Signing in, putting in the captcha, right? Filling in the entire loan application form. All of that can be automated. All right. That pretty much allows that employee, the ops guy or the sales guy, right, to do two other things more. Okay? And that increases efficiencies, right? People who want to, be in this industry and prepare for these changes, typically you would want to start asking yourself, what can I do with technology? As a techie over the period of 15, 16 years, what I've realized that most non-tech guys have so much better ideas, right? They don't have an enabler or a tech guy, right? What anybody who's in this automation world, right? What they need to do is they need just to come up with good ideas for improving their service, their product, right? And throw it at the tech guys and check with them. Can we do this?
And then just to thanks, Prasad, this is helpful. And just to add the element of AI here, because there's another question while you are at it. So, in terms of decision making, AI being used for key decision making, and how do we, is there a need for human intervention? To what extent to review the AI output? And could AIs reach a stage where they are accountable for their own actions, and they are sort of independent? So
This is a good question. This guy is a sci-fi fellow, Blade Runner, right? So I think everybody wants that technological singularity to be achieved. The point where suddenly AI achieves sentience, right? That's technological singularity, right? And people want to know what will happen in this space where suddenly the AI becomes self-aware and start taking its calls on different topics. And I think we have read about enough AI articles where Microsoft has launched one AI on Twitter, and suddenly it has become a Nazi-loving bot. And now I think recently ChatGPT that people have been talking about, right? So what I see is right now AI is effectively driven by human test cases that typically someone filters and passes on, right? And therefore manages to control the boundary parameters under which that AI is operating. Over a period of time, you would want to see unbiased decisions in your decision making, and that's where you want effectively a rule-driven system, right? There isn't any specific need to have an AI deployed there, or maybe you want to take away the aspect to it, right? All of these are discussions that we could always get into for the future, right? However, I think at this point of time, most credit teams would typically have, an AI output and then having one layer of review, right? Or at least some kind of a mechanism on top, right?
Thanks, Prasad. So, a couple of questions. I'll bundle the two in the interest of time, and both coming from probably the current batch. So, quite a few employees are losing sort of jobs because of the job cuts in the fintech industry. Uh, what do you think is ahead for the rise of such companies? What could have the companies in operations? And is what are the major challenges working in a fintech company on a day-to-day?
Uh, so I think one of the largest challenges is to keep up with the change of the environment, right? One day you could be doing home loans on or loans using the entire jam stack. Suddenly might be a new case where one part of the jam stack is questioned, and now you have to rewrite your LOS, or you have to rethink the way your business rule engine is taking inputs, right? You could be taking loans via an app, and one fine day the app is pulled down, right, due to a whole list of apps being pulled down, right? I think one of the things that you would always want to do is keep up with whatever has been happening. There are always discussions where uh, a certain rule might be changing, right, or a certain rule is relooked at. Okay, so I think ability to adapt, and largely in the space of uh, digital lending, right? Uh, Typically, you will also have to adapt your systems faster. And I think for a lot of business and tech guys in lending, this could be the one of those challenges that my tech has to adapt as soon as possible. Pura 3 mahina nahi lagna chahiye. It should be done by 2 days, and so on and so forth, right? So I think one of the challenges would always be keeping up and evolving, right? Whereas you are not stepping out of the boundaries that have been given by the regulator, but at the same time not lagging behind so much that you are no longer relevant.
That's helpful. Kamal, do you want to add something here quickly from your perspective?
So, I mean, one thing that I would like to say is that you need to keep upskilling yourself to adapt to the job requirement, which is going to be continuously there. I mean, uh, my father worked for an organization for 25 years. I have, in the last 12 years, maybe changed 4 or 5 jobs. So that's something that's going to become, and probably the next 10 years down the line, nobody's going to have a job. Everybody's going to be a gig worker somewhere down the line, working as a freelancer for 10 different products and services. So it is evolving so fast that you have to keep on upskilling and retraining and re-evolving yourself. That's the crux of working, whether in the fintech space or any other. In fact, technology has to become the backbone of all verticals that may exist ever in all commercial spaces.
So that's helpful. A couple of chat box questions, and then we are done with last two questions. One is the use of account aggregators. Where do you, how important do you think that is, and uh, will it help? To what extent it will enhance the efficiency of the lending process? And what all will become redundant with the help of account aggregators, with the right sort of interaction. Anyone? Prasad, Amish?
Yeah, I can take this. Yeah. So account aggregators are India's answer to open banking, right? So if, let's say, currently I want to provide my banking details to a lender, uh, there are multiple ways. One way is that I could give them my bank statement, and the bank statement would be passed by the lending party. Another could be I could give them access to my banking, and then they could pull that data from my details, right? Which is slightly scary, but this is also something that's done. Third, I could give them access to my scanned copies of my passbook, and then somebody will have to read through the passbook or parse the passbook and make sense out of it. And fourth, this is where account aggregators really come into play. Give access to the lending institute via a regulatory framework, which is where my consent is stored, my consent is captured, it is also kept over a period, and then the data is sent over a controlled environment to the financial institution which is requesting the data, and all of this is kept within a controlled structure wherein I know who is accessing my data exactly and for what time, and that's what account aggregators truly mean to the system. So over a period of time, I see AI solving a lot of problems with respect to accessing data, with respect to controlling consent. All right, with respect to creating some fairly interesting products that can be built on top of someone's banking, right? What will be redundant with AI? I think over a period of time, bank statements will be redundant. It will take significantly some time, but yeah, I hope to see the day when we don't have to hand over bank statements.
Okay, thanks, Prasad, for this. And one, probably the last question we'll be able to take up given the paucity of time. This is around, have fintechs increased the systemic risk of the financial system, right? How the regulator is looking at this, and um, the regulators' vigilance and tone on their overall. And I would request Kamal probably to
Yeah, so I mean, it is a difficult problem to solve whether to open our huge data repository to maybe, I mean, attacks from any kind of any part of the world, because eventually the entire financial data is what we're trying to protect, and at the same time also open it uh, to various decision-making support systems that are getting created because of the fintech industry. So one way is to continue working in silos. Other is to find a way and mean to protect the environment in the system in such a way that it grows while remaining, protected also to various kind of attacks. But yes, this is very difficult, and regulator is up. I mean, from all perspective, if I compare this regulator to any other sector's regulator in the country, we are certainly in much safer and better hands. Having worked with some government agencies in different roles, I can certainly say that the amount of time and intelligence that RBI tries to work with, focus upon, there could be a possibility that they might delay things a bit, but they are always active and happy to accept newer technology and interventions coming in. At the same time, looking at the nuances of what is going to happen certainly makes it important to for them to be very, very careful of potential fraud, which I also mentioned earlier. But eventually, fintechs are the only way to reach out to the last person. I mean, without technology, with the current banking setup that we have, or the general brick and mortar system setup that we have, it is not possible to reach out to the last mile. So this technology intervention has to bridge that gap, and that has to come in. So it will come in this way or the other. So whether the regulator approves it or people find a loophole in the system and then create it. So it's better that everybody comes together and work on it, and we are together able to come up with solutions which safeguard the individual interest as well as the overall growth perspective. That's what we can say. But yes, comparatively, I can certainly say that we are pretty confident of the regulator being able to do this and achieve it, rather than if we compare it to, say, other regulators across the globe, as well as other industries and their regulators within India as well.
Thanks, Kamal, for this. I guess with this, we should probably wrap it up, and thank everyone for their time and patience and their questions. I'll hand it over to Professor Ganesh for any closing remarks he want to add.
Thanks, Pratik. Thanks, Pratik. All of you, thank you very much for taking time off and then participating in this panel discussion. So thanks, Ajinkya, Amish, Kamal, Pratik, and particularly Pratik for putting this together. And I also got to know some of the alums whom I have not met. So it was pleasant. So thank you very much. I think it was very useful. hopefully we'll have some other time to sort of touch base with you and have you, present something on this forum or some other forums. So look forward to your visit sometime to the campus. So please do visit us when you have your reunion or in the footprints. So thank you very much.